Hey, what's going on, everybody? My name's Andy. My channel's Finding Value. Today, we're going to rip through Twitter, see what's going on in the Twitter world, just like we normally do. It'll be financial, economic, wealth building type stuff, maybe commodity related or some sector in commodities. That is what I focus on right now. The ratios are cheap, and that is where the value is. I'm going to interject my financial opinions across the board, and we'll dive right in. So you can follow me at finding_finance. And again, if you want to join, we've got finding-value.com. We do have a discount code called discount if you want a little bit of a discount for the first month. And we do have a platinum question and answer session coming up on Sunday, 5 p.m. if you want to join and ask questions. So we've got Gergen, and a last name I probably can't pronounce. Here's some interesting things when you look at these charts here. U.S. Baker Hughes oil rig count. Look at the pullback here. 1 hump, 2 hump, 3 hump. And then we'll probably start to move higher at some point. We can also see these like waves coming up on the up move for weekly crude oil production per rig. And then if you look at U.S. Baker Hughes natural gas rig count, we've had a monster move to the downside since 2008, all the way back down. It looks like we're bottoming and starting ready to come back up for the Baker Hughes natural gas rig count. So that's some interesting stuff there. We've got Charlie Munger fans. The riskiness of an investment is not measured by beta, but rather by the probability, the reasoned probability of that investment causing its owner a loss of purchasing power over his contemplated holding period. Beta is a measurement of volatility, if I can remember. And they don't view risk as volatility. They view it as the reasoned probability that they could potentially lose money over a certain holding period. That is how I view it. And what I do is I lengthen my holding period. It's very hard to get a cheap, gigantic asymmetric bet and lose money if your holding period's pretty long. Yes, there's going to be companies that don't perform as expected. There's going to be risks that do potentially come where you could lose money. And a lot of the investments, if you are reasonable about the companies that you have selected, will do very well over a longer holding period. And a lot of the stuff that I have adopted and have learned has been from Peter Lynch, Warren Buffett, and some of those things, from the emotional aspect, from the fear aspect, from the holding periods. I do take some of their quotes here and sayings to heart. I think Warren Buffett he's pretty good. I mean, he's loading into oil. He loaded into PetroChina back in the day. I saw him buy it. And he made a killing on that. He's got a lot of very well-timed purchases in these cyclical industries. I don't know what he uses to determine when to buy and when to sell. I don't know if it's the real estate cycle, business cycle, a combination of all those things, but he has done incredibly well on timing a lot of his purchases. He says, the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. So he's just waiting for the opportunity. Just wait for the opportunity. And what he means by the sweet spot, maybe it's a March 2020 event where things sell off. You get a really high quality company and you just buy the living crap out of it. I think that's probably what he's doing. He's using the business cycle or the real estate cycle. He gets a big crash and he waits for that crash to occur, and then he buys the living crap out of it. And I don't think he's buying all the time, but I mean, right now we do have opportunities that are still out there that are very cheap in commodities and energy service, energy all over the place. I know he's been a big time buyer in energy. And eventually those deals are going to go behind us. And we're going to have to wait for a period. We could still look for deals, but the deals are not going to be as plentiful. they're not going to be as readily available. I do have a few ideas that I'll share this weekend in the question and answer session that I really want to share with you guys. They look like they could really take off. And there's a few that they may grind on the bottom a little bit, be a little bit more patient, but they look pretty good in the energy service sector. I'll talk about those Sunday. Annualized U.S. interest expense has gotten completely out of control. U.S. interest expense is about to hit $1 trillion for the first time in history. It's now rising exponentially. This is from the interest rates going up. It is also from how much debt they're releasing. It's a combination of those two things. I don't like seeing this. I mean, you can see there's kind of a very slow move, an accelerated move here, and then we had interest rates kind of come back down for this period here, and now interest rates are going back up. And this is a big fat breakout on interest payments. This could be the beginning of the end. I don't know. A lot of people say that when you basically you start going vertical like we are, that maybe a very high inflation is coming from this side of things, the fiscal side. Petrobras sets dividend policy at 45% of free cash flow. Oh, thank God. That is awesome. 45% of free cash flow. I don't know what it is at this exact moment. I'll have to look. But 45% is a pretty big amount. You get a 25% bump in pay at work. How do you celebrate? I will tell you this, guys. I have never received a year-over-year 25% pay bump at work. Never happened. I've worked at large corporations. I made a good amount in the employee stock purchase plan when I was originally working, but they took all that away. But yeah, I've never received a 25% year-over-year pay bump at any job that I've worked. It's always been the biggest one I probably received is maybe 12 or 15%, somewhere in that range for a promotion, if I can remember. And that was a long time ago. It says most millionaires invest in stocks, but most beginners lose money in their first 2 years of investing. So before you hit the buy button, ask yourself these 10 questions to ensure it's the right investment for you. Let's go over the 10 questions. What is my goal? The first and most important question to consider before buying anything is, what am I trying to accomplish? Investing for retirement or investing for a down payment on a property are two very different goals that require very different strategies. I don't think the strategies are that different, but it depends on when you need the money. If you are trying to save money for a down payment, I wouldn't go into stocks. Maybe that's what he means by strategies, but I would be looking at bonds or something that is way different than stocks that do not have the volatility. If you've got a long-term outlook for retirement, then yeah, the volatility is not going to bother me. You're going to be in it for a while. What is my risk tolerance? If your goal is to make as much money as possible and your risk tolerance is extremely high, the lottery or YOLO bets on obscure cryptos might appeal to you. Just consider that these investments almost guarantee you will not reach your goal. Well, I don't think taking on more risk is necessarily going to make you more money. The special sauce that you want to look for is a very good opportunity to accumulate assets that are very cheap, that pay that have good cash flow. So you're using the market conditions or the timing or a crash to load up on very well-run, good cash flow companies. The risk, when I look at risk is the ability to see higher cash flows in the future. And if you cannot see a clear line to increase cash flows in the future, your risk is high. So it's a company that has a lot of debt and you don't see where the cash flow can come from to service that debt. Or it's a company that is a developer and will not generate cash flow for another 5 or 10 years. And it's like, when are these guys going to get the cash flow? They could be building a mine and maybe you catch the speculative, money coming into the sector and they go up dramatically sometimes. But it's a riskier bet. The best bets that I've made are ones that were just completely out of favor. The commodities bombed out. These companies had debt, and then the commodity price came back and ripped it to the upside. They didn't go bankrupt and everything unwound when their cash flow from the infrastructure they have in place dramatically increased. Their return on equity and all that stuff, you can't really value the company based off cash flows because the commodity determines their cash flows. So it's one big leverage play to the commodity price. And those are my favorite to play because you can get the largest gains in the shortest period of time of any investment. Crypto could be like that. And I never really dabbled in crypto because I don't know where the value comes from crypto. But that's my favorite is commodity type companies. It says your tolerance needs to align with your goal and the time horizon of that goal. Generally speaking, the higher the risk, the higher the potential return. And the lower the risk, the lower your potential return. I don't agree with that statement, guys. Even though he's generally speaking, higher risk, it does not necessarily mean higher potential return. And I described the basic situations that I look for. You want fear in the market, buy high quality assets, and then some of those, depending if they're like high cost producers, which is not a bad thing, they're just more volatile. However, time is another factor. With stocks, the longer your holding period, the higher your chances of a positive return. So this is your probability of positive return. So this is your holding period, and it goes way up, almost 100% if it's a 13-year holding period. What if it goes to zero? There's a real possibility that any investment can go to zero. Ask yourself, will I be financially devastated if this goes to zero? If the answer is yes, either avoid it or consider ways of mitigating the risk and lowering your exposure. That is your portfolio position size. That is how you're mitigating risk. Because, however, if you're investing in a fund like the S&P, the chances of it going to zero are very low. If they do, this would mean the collapse of the United States economy and much of the global economy these businesses transact with. So you're talking nuclear holocaust or similar, in which case money doesn't matter. What is my investment time frame? Generally, the longer the time frame, the more risk you can accept. Because you have more time to recover from losses and to ride out the volatility of higher risk investments such as young companies in their rapid growth phase. And remember, volatility does not mean higher risk per se, according to Buffett. It's your probability of getting or seeking a positive return versus or a probability of getting a loss in your return over a given time period. Volatility is not one of the things that he measures. Consider if each investment makes sense from a timing point of view for you. When and why will I sell this investment? If you know why you were buying it, you should have a good idea of why you would sell it. If you buy because you're expecting a 20% revenue growth, you should generally sell if revenue growth does not meet your expectations and shows no signs of recovery. If you buy for a dividend yield and it's withdrawn or reduced due to falling earnings, it may be time to sell. And this is where all that market timing and money flows comes into play that we do. It's not short-term market timing, it's long-term. Who am I investing in? It's very difficult to judge the capabilities of management team with the limited info you have access to. Look for a successful track record, compensation schemes, a high amount of net worth invested in the company, and founder-led. So high insider ownership. Am I diversified? There is a clear line between balanced diversification and over-diversification. In my opinion, a retail investor should limit a portfolio to 10 to 12 stocks. Any more, and you won't be able to keep up on top of earnings to monitor company success against your thesis. This is difficult to say because I hold a lot more than 10 or 12 stocks, and it depends if you want to dabble in the speculative sector. If you dabble in speculative sectors, what you're going to find is that a lot of these companies can get decimated. And that's why you have to spread out. 10 or 12 is a concentrated portfolio. And in order to concentrate, you're going to have to pick cash flow rich companies, period. You cannot go and buy a uranium junior company if you only own 10 or 12 stocks. Now, that's my opinion. You can do whatever you want, but you're taking on far too much risk of not seeing that direct line to cash flow generation. And I just think it's very risky. But you know what? You can do whatever you want. Is this an area of my competence? Peter Lynch is famous for his theory that ordinary folk have a huge advantage over investment professionals in the field they work in. This is because they'll never have the knowledge of someone who works in that field. Use it to your advantage. Why do I still own that investment? It's good practice to reassess your investments regularly and ensure you still want to own them. Selling for a loss or cutting a big winner is difficult if you let your emotions get in the way. And this is where you need to know what the valuations are and what the sector is doing. If the sector's low and we're kind of trying to buy a bottom, it may have some losses. You may move or go down 20, 30%. And then you need to be able to value your assets and know when to sell when the cycle's done. When the cycle's done and the tailwinds are gone and the sectors are overvalued at that point, you get out, period. It's just the way it is. So yeah, that's what we've got there. Oh, there was one more there, number 10. So number 10 is, if we were to look at it, of course I blew right by it. Should I be managing my own investments? Many people try to manage their own retirement savings in the evenings and weekends. This can be hard to keep on top of, and paying someone else to manage it for you can cost you considerably, especially when the factor in fees and active managers' inability to outperform the market over time. Therefore, consider low effort, low fee investing strategies such as an index fund and ETFs. I think that's okay depending on where you are in the cycle. And if you take a very long time frame, like 40 years, you'll probably be all right. I do think that we are coming up in part of a cycle where commodities will outperform stocks and stocks may not do as well on a historical basis. It says few people realize how well gold is doing despite the massive headwinds from surging real rates. He knows what to talk about here. It is surging real rates, and gold has actually has done very well. Here are some thoughts, facts, and two charts by my dear buddy. Front end real rates, measured by the 2-year tip yield, have risen 600 basis points to almost 3%. And part of that many market participants are overlooking is that the last 150 basis points have occurred over the past few months. So basically what he's saying is that yields have gone up quite a bit, and the real yield has rocketed here since April 5th. And we're still sitting on top of the pattern for gold. Hasn't really moved. So I think gold is setting up, and people are positioning in gold for a potential move, and a move in rates to the downside. It says, believing you'll know the exact moment to take your chips off the table in a bull market is the biggest lie we tell ourselves. Gradually scaling out is the only practical way to exit. Yes, you'll miss the top. Yes, you'll leave a lot of gains on the table. Accept it. Average income by age, just if you guys want to know, 31,000 is 16 to 19. 20 to 24 is 36,000. 25 to 34, 52. And 35 to 44 is 62,000. Are you above or below that line there? Should 20-somethings be maxing out their 401ks? Yes, they should. And they should do it in a way that benefits them from a tax perspective. When you're younger, you may not be making as much money and paying as much taxes. You may want to choose a Roth 401k if it's available. Or you may want to do a 50-50 split. Depends how much money you make. Depends on what that money is being taxed at from a tax standpoint. It might be beneficial to look at a Roth IRA and a Roth 401k and do a lot of investing up front in those types of vehicles and pay the taxes up front if you don't make that much and you have really low costs. Now, I'm not an advisor. I'm not telling you guys should be doing this, but it might be something you might want to ask a financial advisor or a tax advisor those questions. Gold, posting the roadmap does not mean I am biased. It does not mean I'm a permabull. Our trades have been beaten, etc., by a wide margin precisely because we replaced bias with science. And here we are sitting on top. It's a breakout and a back test. Now looks ready to move up. Need confirmation on the monthly close, and he's talking about gold. And we're above all the clouds. Everything looks good. We're above all the support resistance lines. It looks like it wants to go higher to me. Patrick Karam says 1970s all over again. Prepare accordingly. While the core PCE price index has always gone up, this is your 1-year rate of change. We have got a big year one rate of change. We've got that nice little consolidation zone. And I think it's going to start moving up again. So we've got our first wave off the base. So it's a downward move, a base, and we've popped higher. And I think we're going to start to move to the upside. This is where gold and silver outperform growth stocks when this core PCE price goes up. We've got Zillow's gone full-blown housing bull. Zillow expects U.S. home prices to rise 6.3% between June 2023 and June 2024. Among the 200 largest housing markets, Zillow thinks 48 markets will see a jump of 7% or greater. So what they're seeing is the expansionary phase of real estate. And that is where I think we're at. Now, are we going to get a 7% increase in a lot of these areas? I don't know. I don't know what the percent increase will be, but generally, if you look backwards, the greatest gains have come in the expansionary phase of real estate at the end of the real estate boom. That's generally where they open up and loosen the credit standards and just start throwing loans to everybody. It doesn't matter what the percent is at that time. They just literally start giving out loans. We're not there yet. And it might still be a couple of years before that happens. It's called the winner's curse. And it's usually a very big number. It could even be greater than 7%. It could be 10%, 12% increases in real estate prices. And I know that sounds crazy at this time. Just wait and let's see what happens. That's what I'll tell you. The energy sector is poised for another major move to the upside with exploration production stocks likely to break through this multi-year resistance level on the monthly chart. Operating rig count falling. SPR is already at the 1980 levels. Ongoing deglobalization trends and overall capex for the sector remains historically depressed. After being down 45% from its recent highs, the risk reward to buy oil and energy stocks today continues to be heavily skewed towards the upside. This is oil and gas exploration production stocks. If you draw the line differently, so if you draw this line going kind of across this way, going across, you have an inverted shoulder, head, shoulder, and a break of the neckline would be coming soon if you draw it across this way. That is what I'm seeing in a lot of these stocks. They are inverted head and shoulders. And it's not just in one of them or two of them. It's across energy service. It's across exploration production. It's across oil, nat gas. It's in other commodities as well. What I look for is that confluence of all these things to occur. The confluence of information makes that case that the probability of success is even stronger. In fact, it's way stronger. It's not I'm just going to take a random chart and throw it up. No, this is the entire complex doing it. And there's other inverted head and shoulders and gold and silver mining companies as well. And we're going to go over all that in a lot of the companies that I do in our, in the service of the finding-value.com. We've got some really good entry points across energy service, exploration production, and I think precious metals will come. We just have to be patient, guys. We have to be patient. How inflation might play out. This is the Bank of America, and it looks like they're expecting a potential move higher in inflation. There's a couple scenarios where it dips a little bit in quarter 3, quarter 4, perhaps, and then it starts to go back up again. So that's some. I should say this. It dips to 2% inflation. So 2.5%. It dips down to 2% and goes back up. And these are far faster over here. I think that it's going to be greater than that. The reason I think that is your base effect and how you calculate it's coming up. And then you also have commodities that are taken off now. But that's where I'm going to end it, guys. I do have a new computer here. I do have a new microphone. Let me know how this is all working out. I'm not getting the breakup. It's got a much better graphics card and all that stuff. So I did get it. I just got it today. And hopefully it works a lot better than my old one. So that's what I've got. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you later. This is Finding Value.